Welcome to the Advisory Group's End of the Year Proactive Tax Planning for 2025 video. Let's first start with some introductions. My name is William Glenn, and I'm a Client Services Associate as one of the TAG team members. Also joining me today are Brent Beverly, the President of the Advisory Group, and Manny Chinche, a Senior Advisor at the Advisory Group. Both of them, along with the Advisory Group's Vice President, Chris Lee, are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with any clients any knowledge that can help them make an informed decision. We have said it many times. We believe that taking a proactive approach to your tax planning instead of a reactive approach could produce better results. As we get close to the end of the year, time is running short to save money on your 2025 taxes. To get us started, let me bring up Manny Chinche. Manny?
Thank you, Will. As I'm sure all of us are already aware, the One Big Beautiful Bill Act was signed into law on July 4th. Now, this massive bill incorporates a wide range of tax and spending policies aimed at providing relief for taxpayers and boosting economic growth. This bill made permanent many of the individual tax cuts and reforms of the 2017 Tax Cuts and Jobs Act, better known as the TCJA, that were set to expire at the end of this year. Now, while there are a whole lot of provisions packed into this act, here are some of the key items we feel apply to a large group of our investors and savers. Now, we covered these strategies in some detail in our October webinar. However, we thought it would be a good idea to leave you with a checklist of proactive tax strategies for 2025 to review after you view this video. Now, this checklist on your screen is also included in our newsletter that is coming out at the same time as this video. The Tax Cuts and Jobs Act income tax brackets were scheduled to sunset at the end of 2025. Now, these brackets are now extended and made permanent, saving millions of taxpayers from a tax increase. As a quick note, when we say permanent, what we mean is that it takes another act of Congress to change them. Unlike the rates in the TCJA, where the rates were set to expire at a certain date, the new provisions have no end dates. Now, there was also a slight upward adjustment to the top of the 10% and 12% brackets, thereby granting a small amount of additional relief starting in 2026. This is a sigh of relief for taxpayers that could have seen higher tax brackets, including the pre-TCJA highest tax bracket of 39.6%. The TCJA nearly doubled the standard deductions while eliminating personal exemptions. The One Big Beautiful Bill Act made the higher standard deductions permanent and also provided a slight increase. Starting in 2025, the deduction will be $15,750 for single filers, $23,625 for head of households, and $31,500 for married individuals filing jointly. Now, there's a new deduction for taxpayers who are age 65 before the end of the tax year. From 2025 to 2028, qualifying individuals may deduct up to an additional $6,000. Now, the deduction phases out for incomes above $75,000 for singles and $150,000 jointly. The deduction phases out over the next $100,000 in taxable income, so it is completely phased out for singles at $175,000 and at $250,000 for couples filing jointly. This deduction is meant to partially fulfill the president's campaign promise to eliminate taxation of Social Security benefits. However, Social Security benefits are not required to qualify for this deduction. Starting in 2025, the state and local deduction, the SALT, is raised from $10,000 to $40,000, with a 1% increase in the cap each year through 2029 before returning to the $10,000 limit for 2030. The $40,000 deduction cap is phased down to the prior $10,000 cap for taxpayers with a modified adjusted gross income of over $500,000. The phase down occurs over a $100,000 range from $500,000 to $600,000, and therefore taxpayers with a modified adjusted gross income of $600,000 or more are limited to a SALT deduction of $10,000. There are also new provisions in the One Big Beautiful Bill Act that provide tax deductions for tips and overtime pay. Now, these deductions are available from 2025 through 2028. The deduction for tips received is up to $25,000. However, there are a number of qualifications, including the fact that the tips must be received in an occupation that customarily and regularly receives tips, such as serving. Individuals who receive overtime pay that is required only by the Fair Labor Standards Act that exceeds the regular pay are also entitled to a new deduction. This deduction is capped at $12,500 for singles or $25,000 for joint filers. Now, both of these provisions are phased out for earners making over $150,000 or $300,000 filing jointly. It's pretty complex, so be sure to work this out with your tax advisor. Now, some other notable changes include the child tax credit increased by $200 and is now $2,200 effective in 2025. Now, this credit is reduced or phased out for single filers with incomes above $200,000 and over $400,000 for those filing jointly. The TCJA reduced the loan principal, which could incur deductible interest from $1 million to $750,000. The TCJA also eliminated the deductibility of mortgage interest not attributable to acquisition indebtedness. The new bill made these provisions permanent. However, it does restore the deductibility of mortgage insurance premiums. There's a new temporary provision that allows the deduction of interest on certain loans used to purchase personal vehicles made in the USA. This deduction is effective from 2025 through 2028 and phases out on incomes above $100,000 for singles and $200,000 for joint filers. And finally, the Section 199A deduction, also known as the Qualified Business Income, the QBI deduction, or the pass-through deduction, was enacted as part of the Tax Cuts and Jobs Act of 2017 to provide a tax break for many owners of small business.
Well, thank you, Manny. Now, almost all those new rules that Manny just covered phase out and go away as your income increases. Now, we've put together this chart with a summary of the phase-out rules for 2025. Now, we noted earlier, these are pretty complex, so be sure to work this out for your specific situation with your tax advisor. We would also like to note that if you're on or getting ready to start Medicare, you also need to be cautious of the IRMA, the income-related monthly adjustment amount. Say that 3 times real fast. That's why we use IRMA. Now, these IRMA surcharge rates can sneak in and raise your costs. And while this doesn't show on your tax return, it can be a significant increase in your expenses just because you took a little more income. Just $1 over the limit raises your monthly charge for Medicare. Now, there's a chart for this on our tax triangle, which is on our website if you actually need to know the figures. There's also a 2-year look back on it. So what you do now, if you're turning 65 in a couple of years or you're already near or over 65, there's 2-year look back. So you need to be paying attention to this. We thought you might also enjoy a summary chart on the timelines associated with some of the new tax policies included in the One Big Beautiful Bill Act. Now, we covered these changes earlier, but check the scheduled ending of the no tax on, say, tips or overtime, as well as the new $6,000 senior deduction and the deduction for auto interest on U.S.-made cars. Now, the timeline is different for the expanded SALT cap. Remember that state and local tax cap. So take a look at it here. The increased standard deduction, as well as these other items in the estate tax exemption increase, have been made permanent. Now, we want to define that permanent again. Remember that it doesn't need to be renewed, but it can be changed. These last 2 charts that we have here are used with special permission from the Academy of Preferred Financial Advisors. Because we feel that these 2 pages are so important, we've included them into this presentation. This way, they're larger, easier for you to read. So, how should you use and view the itemized deductions if you have enough deductions to go beyond that extended standard deduction? The old rule was primarily to accelerate or recognize deductions, take them as quickly as you could. With the higher standard deductions, oftentimes the new rule is to time or carefully plan when to take your deductions. Bunching deductions into a given year may more effectively use these expenses from a tax perspective. In 2025 and moving forward, long-term capital gains still receive substantial federal income tax breaks. Now, as shown as this chart, there are still three tax rates of 0%, 15%, and 20% for long-term capital gains, which are for assets and investments that you've held for at least a year or more. Okay, long-term capital gains, more than a year. Since capital gains rates are still favorable, as part of a year-end tax planning strategy, it can be helpful for taxpayers to review tax gains and loss harvesting. Now, harvesting capital losses is a strategy where the taxpayer sells assets that are at a loss to offset capital gains, either in the current year or in the future. Now, this is a tax deferral strategy that can be valuable. Recognize that you need to be out of that item that you sold to recognize the loss. You have to be out for at least 31 days before you can buy back that or a similar investment. So you are out of the market for a period of time. Now, a key fact to remember in this whole thing, you see at the bottom there, is that you can use up to $3,000 in capital losses above what you offset capital gains with to offset your ordinary income. So it does, again, you're taking capital losses and being able to use them in many places. Another form of harvesting is that capital gain harvesting. Capital gain harvesting means taking the capital gains and paying taxes in the current years. And you might look at that and go, why would I want to pay taxes early? Well, remember, when harvesting long-term capital gains for tax purposes, although the tax is paid at a lower rate, it's paid sooner. Well, if you happen to be in a 0% tax bracket for capital gains this year, well, gosh, let's take the capital gains this year and then go ahead and get back in if you want and continue it for the future. But you've raised the basis in your gain in your investment. And gosh, particularly if you're in that 0% bracket, but even if you're in the other lower tax brackets, it may be worthwhile to go ahead and recognize those gains early and pay tax on them early. So this acceleration of gain is particularly advantageous when you're in lower tax income years. Now, here's some of the 2025 contribution plan maximums that would be applicable if you're participating in one of these plans. Now, note that these catch-up provisions, okay, catch-up, what is catch-up? Catch-up provisions allow additional funds to be contributed for those over age 50. Now, I want to draw special attention to the lower right-hand corner here. The lower right-hand corner notes that someone between age 60 and 63 gets an even larger amount of catch-up contributions. Also, there are new rules kicking in for 2026 and beyond that will require the catch-up provisions to be donated into a Roth provision, that is not deductible, if your earned income is over a certain level. Now, that's $140,000 in 2025 dollars, but it's expected to be increasing with inflation for future years. I know this is complex. If you have any questions about retirement plans, please be sure to contact us or your tax advisor. For some people with IRAs that have not been taxed, a partial or full Roth IRA conversion can be something to consider. Some of the benefits of a Roth IRA conversion include they lower your overall taxable income over time. It can. Roth IRAs enjoy tax-free compounding. In other words, on that compounding, you're never paying tax on it. Roth IRAs have no required minimum distributions or RMDs. And Roth IRAs allow tax-free withdrawals for beneficiaries So it's not only yourself, it might be your high earning kids or something or other beneficiaries that you're leaving it to. Gosh, this means you're leaving it to them tax free when they pull it out. So Roth conversions are not for everyone, but if you would like to explore this, please make sure you see us and or your tax professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. This is not an automatic decision. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, for example, and income limitations for future contributions into a Roth IRA. In addition, you're required to make a required minimum distribution, an RMD. If you're required to make that RMD in the year you convert, you must take your RMD first, and then you can look at doing the Roth IRA conversion. You have to take the RMD. You can't take your RMD and put it into a Roth. Especially with these new tax rules, doing a Roth conversion may trigger phase outs, as we just covered, of some of the deductions you may otherwise receive. So by all means, make sure you're working with your tax advisor, with your financial advisor to determine these amounts that work best for you. This is not an easy decision. I alluded to this earlier. You want to make sure that you're looking at your overall family tax bracket management as a critical area for those with untaxed retirement assets to explore each year. One of your choices is always to leave everything currently the way it is, and for many people, that's the way it works. But if you're in a higher marginal tax bracket than your beneficiaries, it might make sense for them to take the distributions after your death in their lower tax brackets than you and yours. However, if your beneficiaries are in higher marginal tax brackets, then it may make sense to take distributions in your tax bracket before you pass away, convert those accounts to Roth IRAs, and then leave your beneficiaries an account. While it must be taken out within 10 years of when you pass away, it can grow completely tax-free through that 10 years and when they pull it out. An annual step to consider is to review not only your marginal tax rate, but your beneficiary's marginal tax rate, and do that each year. Now, an example of this, you may be in retirement, so you don't have a whole lot of income coming in, while your kids, when you're expecting to pass away, they may be in their highest earning years. Well, guess what? This may be a way to help them remember you better. Let's talk a little bit about annual gifting now. Now, you may gift up to $19,000 gift tax-free from each donor to each donee in 2025. This is a $1,000 increase from the $18,000 we saw in 2024. And we like to express this as a tax-free gift is a $19,000 per year per person per person. Okay, it's per giver per donee. Okay, so in other words, let's put it into effect. The annual exclusion of gift is doubled to $36,000 per recipient for gifts made by married couples. Okay? Husband and wife, as an example, leaving to one of their children, each can do $19,000 for a total of $38,000 this year in gifts without filing an annual tax return or without filing a gift tax return. These annual exclusion amounts do not reduce your lifetime gift exemption, do not require filing of an additional gift tax return. Now, we've just got the figures of this increasing for 2026, but we're focusing on 2025 here. Now, another way to do this, to help your kids, for example, or help someone else, is to pay for medical or educational expenses without factoring against the gift taxes. Now, this doesn't qualify for 529 plans, but if you're paying directly to an educational institution, or if you're paying for somebody's medical expenses, this may provide a way for you to do that without it being a gift to the person who's affected. Now, some restrictions. Okay, guys, some restrictions. The medical expenses must meet the definition of, I love this, deductible medical expenses. So the IRS has a full log on that. And qualified education expenses are things like tuition, books, fees, and related expenses, but do not include room and board. Now, you can find the detailed qualifications in IRS Publication 950 and the instructions for IRS Form 709. There's a link via our website to the irs.gov website. Qualified charitable distributions, QCDs. We've talked about this before, but they're still a good strategy for many people for their retirement plans. As a part of the Secure 2.0 Act, required minimum distributions, or RMDs, were changed to start to age 73 instead of 72. For anyone born in 1960 or later, the RMD age is actually changed to age 75. The qualified charitable distributions, or QCDs, are a law provision that allow retirement savers, you're going to love this, back to the old age for RMDs, age 70 and a half, to directly distribute up to $108,000 to an eligible charity straight from their retirement accounts and not pay any tax at all on that distribution. One idea that experts suggest is that if you are charitably inclined, consider using part or all of your required minimum distribution, RMD, for a qualified charitable distribution, or QCD. If you meet the qualifications to use this strategy, the funds must be out of your IRA by December 31st of the year you're doing it. So in this case, December 31st of 2025. They must also go directly to the approved charity. Now, if you want to verify that your charity is indeed an approved charity, we have a link on our website, www.tagfinancial.com, that will get you directly to the IRS tax exempt organization search tool. Like many other strategies we're discussing today, this is an area that needs to be done properly. So please see us and your tax professional before you go try and do this on your own. So to take us to the end of today's presentation, let me please bring up William Glenn. Hey, Will.
Thank you, Brent. So, what can you expect from us at the advisory group? These have not changed since our October webinar. One of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication and more frequent discussions. And you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. In fact, we will almost definitely be offering other workshops that highlight tax changes and planning ideas. Please pause and read through these disclosures. If you want to reach out to us, here's our contact information at the bottom. We'll post this again at the end of this video. We're thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first. Your health and well-being is always our highest priority. One of the major advantages as a financial advisory firm is the advisory group's team, which we like to refer to as our TAG team. We are proud of our team and the high quality service we all provide. Here's the information for you to reach us, and we are glad to be of service. This concludes our presentation. We hope everyone has found it helpful. Thank you for a great 2025.